I'm going to do something a little bit different in here, and I'm going to bring you a Tools for Techs. We do this for our members. Our Tools for Techs video segment has just a great selection of videos. There's over 80 videos in there that has really expanded. I'm going to do a short little one here because I think this is important on the messages for 5 stocks and how we do this analysis, and maybe even messages for the market. So we think that these 5 stocks are warning of a major top for them, and this may be the beginning of something that's happening as we see almost no good upside coming even after huge 87% of all stocks in the S&P 500 beating on earnings. The market really stalling on that, and if there's any little whiff of guidance that's a little bit softer or earnings that don't make estimates, the stocks are falling pretty hard. And we're going to show you how to put together some gaps and cycles as we do this analysis. So I'm going to switch over right now, and we're going to start out by looking at some charts. And this is the first charts we're going to look at, and this is Citrix Systems. This analysis that I'm going to show you is weekly and daily. And just so that you see what we're looking at here, we're looking at a 10-year weekly chart, a 2-year daily chart. And this is cycle analysis, but we're going to start out by looking at the gaps and then applying it. What happened in here, as the news came out about Citrix earnings, the stock had this big gap. Now, we're going to talk about the importance of gaps. The first thing I want to say is that I do not believe it is fruitful to look for gaps to get filled. The messages in gaps are much better, that they are important when there is a high volume, that there is going to be some continuation, that there's an important meaning on that gap, and you see this high volume right over here. We also look at momentum. You can see momentum basically was neutral, very choppy in here, and now has gone negative again in Citrix. So as you can see in here, as we look at this big gap right over there, so the stock comes down from this level right about 145 and trades down here to about 122. And based on what we see in here, this is likely the start of something. Now I'm going to switch over to the weekly chart and to give you a little taste of the analysis. And if you just watched RV in that preview of ETFs, then you get a little sense for what we do here. We look for the money flows, the rhythms in the market that you can see right in here. And these are cycle brackets, which simply are guides to the rhythms in the market. What we look for is a somewhat close amount of distance between important lows. That's called this cyclical period or length. And you could see the bottom that came right over here, and the bottom that came here, and the bottom that came here. Very nice rhythms in there. Now, I want to note, in cycle theory, when you get a cycle that rallies very strongly and then gives up more than 78.6%, the odds are very high that it's going to fail in the next resistance zone. And we put that in there with what we call swing high, swing low analysis. And in this case, it's a sell zone because it got below the 78.6%. So you had this rejection go on in there. In fact, a number of them in that area, and then this big bad down week on Citrix earnings report. So if I put the side-by-side up right over here, you will see that what we got during this period, and there are cycle rhythms on the daily also, that it failed in this area here and then gave you the big downside gap. What that points to is coming down to about 110, that next support area, and that coming in the beginning of July. So you can see this would be a time frame where between now and the beginning of July, that's about 10 weeks time, that it's going to likely continue on the downside and rallies will fail. So here's your big downside gap right over here. It aligns with that weekly, and we are estimating that a cycle low is due soon. You'll get a rally into another sell zone right over here. We'll put that in once we get a good anchor point, and then down again and heading towards this $110 area. So that is a picture of a cycle analysis and adding in the information that comes out of a big downside gap. And we rate Citrix a sell based on this. Now, it was a sell anyway, but it's really confirmed that to us. Let's take a look at eBay. We're going to look at a total of 5 stocks that are giving us this similar information based on it being post earnings. And take a look here at eBay. We'll put up these last few cycles right in here, and you can see in here a similar occurrence. First of all, note the big double top in here. You will also note that it had been positive and we were getting bullish signals. This is the Slim Ribbon PO. This is only available to our level 4 members for the Thinkorswim platform, and I'll tell you a little bit more about that in a few minutes. But that uses this as our momentum indicator, and this being the signal indicator. Now that has turned negative right now. Here's your big downside gap on the earnings report. Of course, eBay did well in the stay-at-home environment and people ordering things, staying at home, and now that's all going to change as the guidance is not absolutely great in some of these. It's not enough to support these prices. When I switch over and look at the weekly chart right over here, you can see what has gone on is that this downturn that you see right over here is very early in this cycle rhythm. Note the low here, the low here, the low here. There's your beautiful cyclicality in there. And then this calls for a decline into somewhere around mid-June to around July 1st. Similar timing. And I want to note that we expect the stock market to do similar. Supports are coming in here about $52 down to the major 38, about $50. So we think this stock is a sell. Again, we'll look at the side by side and you will see the weekly and the daily, the big downside gap right in here, the likely attempted rebound somewhere in here, and a sell zone that will be created, and then the continued decline on the downside on both the weekly and daily. We rate this stock a sell. That is eBay. The next one is F5, FFIV. Again, we're going to start on the daily. You can see the big downside gap. Note that right over here before the earnings report, the stock had a reversal like somebody knew right over there. Now you have the big downside gap. The shorter term pattern says maybe another week. In this case, we put in that sell zone. It might actually be a little bit lower and then down again. So our downside objective based on the weekly pattern is, let me just move this over and then I'll show you the side by side, is coming down here to break this support. Now the fact that it did, if it does, it confirms the major top. Again, you can see the double top. This calls for a decline into mid-June, early July, an attempted rally, and then further price deterioration out into September. We're looking for the stock to get down to potentially 168 to 153. In here where those big supports are, we rate F5 a sell when we look at that. Look at the pattern here as you have that double top. Look at the pattern here setting up the sell. So a rally right into this time frame takes you somewhere out into here and then moving down together here into the June time frame. F5, we believe it is a sell. The next one is NOW. And this stock is another one with a big downside gap. This we left the weekly resistance zone in here for you to see, and as it got up into there and now has that big downside gap also. When I look here at this pattern, this is a big downturn right over there. Now it's interesting, it gets down to the 78.6 here. You can see the cycle low here, the cycle low here, the rally, but because it got so deep into this cycle, we would expect it to fail in this zone, and it did. It points to a decline down over here to potentially 430. That's about 80 something points on the downside between now and August. We rate NOW a sell. That is ServiceNow, and ServiceNow is a stock that the analysts are beginning to downgrade, and you can see in here the earnings for 2021 getting downgraded. Take a look at that forward PE. Another stock that did really well during the COVID crisis and is just massively overpriced. And the slightest little hint that it's not going to do well in earnings, and you can see the big downside gap. We rate ServiceNow a sell. And the last one we're going to look at, but certainly not least, is Twitter. Twitter has a big downside gap that comes today on Friday as their earnings come out. Simply, they have a monetization failure. Essentially what's going on. They don't even know what their model is. They've been trying some changes. They've tried to compete with Clubhouse, which is that great audio kind of meeting place, and they have not been able to really pull that off yet. And now this is really key. Not only do we have a gap down, but we break a key support here level. That says that the next rally, which is due to start in a few days, a rebound, will set up a sell and then moving down again. We believe this failure in Twitter is going to send it down fairly sharply in here. And our downside targets, when you look at this, are down over here. This is about $50 at the major 38, and this support zone over here below $43. We think that there is potential for a very large decline in here, and this move to 80 was just a lot of hype and a lot of hope. See that big reversal right in there, and then the cycle low that was due right there, perfect. You can see that the rally that fails breaks the support right over here. It points to continued downside in here and a lot of disappointment in Twitter, and we rate Twitter as a sell. Momentum, as you can see, right over here is turning negative right there, and overall this is a very bad pattern. Those of you that are looking for a fill of the gap by it moving up to about $63, it's possible. I certainly wouldn't play for that. I think that the risks are enormous in Twitter on the downside. And that is a look at the 5 stocks that are showing you gaps and cycles and the important information. But I have a bonus for you. Back some time ago, we did a little piece on gap reverse. What a gap reverse is, or invisible gap, is when a stock trades up based on some good news, usually, probably sometimes makes a higher high or a new high, and then reverses and gives the whole gain up. Sometimes it engulfs the previous day, sometimes it just gets through part of it. There are 5 important gap reverses that came out this week. First of all, Apple. I think Apple, on what should have been great news, on great earnings, on great sales on iPhones, and increase in buyback, that stock acted very poorly, and then it comes out Friday with the antitrust suit from Europe. We think that stock is done and will begin to trade its way to the downside. So Apple, gap reverse, and 4 more stocks with gap reverse that are giving warnings, even though they've been decent patterns. Caterpillar, CAT, Las Vegas Sands, LVS, Advanced Micro Devices, AMD, and Xilinx, XLNX. Take a look at those daily charts. You will see gap reverse sometime this week and stocks that look like they have made peaks. So between those 5 stocks with big warnings of tops that we showed you and the 5s that have these gap reverses, there are warnings coming out that the stock market is, as Paul would say, frothy. And the advances that we saw have baked in a lot of good earnings, and I think that sets up a market that is moving towards an important peak for the year. That's tools for techs, gaps and cycles, and 5 bonus stocks with gap reverse.